If you had bought Apple stock when it bottomed out in March, you would have posted an incredible 117% gain on your investment in just a few months.
Wow.
With hindsight being 2020, it makes sense that Apple was able to post this kind of gain, as due to COVID-19, a lot of investors flocked to safety, and they found safety in these big tech names like Apple, Microsoft, and Google that are sitting on massive piles of cash and have very stable business models, some of which might actually be benefiting from the COVID-19 situation. Now, clearly investors made the right decision, as in the last quarter, Apple was able to post a year-over-year gain of over 10% in their revenues, even with everything that's going on with COVID-19. And with their upcoming 4-for-1 stock split, the spotlight has been shining on Apple for the last few weeks, and a lot of investors are wondering whether they should be investing in Apple now or waiting for after the stock split to buy the stock. That's exactly what I'm going to be covering in this video as I talk about what a stock split is and how it impacts the company's share price. I'm going to be talking about Apple's business and talking about what makes them such a great company to invest in. I'm going to be going over some of the risks that the company is facing that you should definitely be aware of if you are going to be an investor in Apple. And then I'm going to wrap the video up by going over the valuation and providing you all with an investment recommendation for Apple stock. Now, as always, throw any of your comments in the comment section down below, as I'd love to hear your opinion on my videos. And with that, let's get into it. Alright, so I'm going to briefly start us off by talking about what a stock split is, and then I'm going to get into what I think is going to be happening to Apple's share price after the stock split occurs on August 31st. So a stock split is a fairly straightforward concept. Essentially what it is a company takes its current shares outstanding and it divides them by a factor. So in Apple's case, who is doing a 4-for-1 stock split, they're going to be taking every current share outstanding and dividing it by 4. What this does is it divides the current share price by 4 and it multiplies the current shares outstanding by 4. This has absolutely zero impact on the fundamental value of the company, and I want to be very clear about that. The only thing that this does is it makes the share price more accessible to smaller retail investors who otherwise wouldn't be able to afford the more expensive share price. Apple has conducted share splits many times in the past. They had a 7-for-1 stock split back in 2014, and they had 2-for-1 stock split in 2005, 2000, and 1987. So this is nothing new for the company, and I want to be very clear that it does not change the fundamental value of the company at all. It just makes the share price more accessible to smaller retail investors. Now, while a share split doesn't change the fundamental value of a company, becoming more accessible to the retail market can have a major impact on the share price in the short run. So what I think is going to be happening is that when the shares split on August 31st, a lot of retail investors are going to be piling into the stock because it is one of the most well-known stocks and it has posted such excellent returns over the last couple of months. In addition to that, they have posted year-over-year increases in their revenues in the most recent quarter, which is going to lead a lot of investors to wanting to invest in the company. And now that the share price is more accessible, we're going to see a lot of retail interest in the company, and I think we're going to see a lot of investment coming from the retail market. However, while I think that the retail market will be piling into this stock, I think that the hedge fund industry is going to be doing the exact opposite. And the reason why is because hedge fund managers have year-end quotas that they need to meet in order to be paid their fat, juicy year-end bonuses.
Greed, for lack of a better word, is good.
So what happens when they make an excellent investment like Apple at the beginning of the year is that they begin to unload their position towards the middle or end of the year so that they can lock in those gains and be paid that juicy bonus at the end of the year. But hedge fund managers need a lot of volume in order to offload their positions because generally they're holding a lot of shares, and if they were to just dump those shares on the market at any given time, that would negatively affect the share price and would cause them to get a worse exit price than they would if they did it on a day that had a lot of volume. So I think that the retail market is going to be providing the perfect exit opportunity for the hedge fund industry because there's going to be a lot of volume coming into the stock due to the stock split, and the hedge fund industry is going to be offloading their shares on that increased interest from the retail market. Now, while the hedge fund industry is dumping their shares on the retail market, this isn't necessarily a bad thing for retail investors as long as the share price is not overvalued. And that is what we're going to talk about in the valuation section of this video. But you should know that just because the hedge fund industry is dumping a specific stock doesn't mean that it's a bad investment as long as the company is not currently overvalued. So given that the retail market is going to be buying and the hedge fund industry is going to be selling, I think that it is a little bit difficult to say exactly what is going to be happening. However, I do think that the hedge fund industry is probably going to outweigh the retail market, and I think that the hedge fund industry dumping on the retail market is going to negatively affect the stock price in the short run. However, in the long run, I still think Apple is a great investment, and we're going to talk about what the company's valuation is at the end of this video. So you should stick around for the valuation section, or you can skip ahead using the timestamps in the description down below. So now let's get into the business analysis and talking about what makes Apple such a great company to invest in. And to do that, we're going to be talking about the 3 pillars that Apple has used to build up one of the greatest companies that has become one of the greatest investments of the last 2 or 3 decades. Now, the first pillar that Apple has built their business on that has led them to becoming one of the most successful companies in the world, and is a pillar that I think is the most important to the company, is that they are always producing excellent products and services. Now we can thank visionary Steve Jobs for this, as he was always laser focused on producing the best products that would provide consumers with the best experience. Now I don't think anything exemplified to me how strong of an advantage this is than when my girlfriend recently broke her iPhone. She broke her phone early in the morning, and by noon she had already bought a brand new iPhone. No product research, didn't care about the price, she just went out and bought a brand new iPhone. And this is something that a lot of iPhone users will say that they do. They don't even care to look at other products because they are so happy with their iPhone product already that they don't need to do any product research. They'll just go right out and buy a brand new iPhone if they need a new one or if they break their current one. Now this is something that you do not see in today's buying environment, as consumers are very informed and they like to go out and look at their options before they make a purchase, especially one as large as an iPhone that can cost over $1,000. But Apple has made a product so good that consumers don't even care to look at other options, and they'll just go straight out and buy a new iPhone. This speaks volumes to how successful Apple has been at creating excellent products, and is going to provide them with a huge benefit in the future, as they are able to retain a lot of these consumers within their product ecosystem. And a lot of this comes from their iPhone, where they have just under 50% market share of the US smartphone market and about 25% market share of the global smartphone market. Now they're able to leverage this market share in bringing consumers into their product ecosystem, which is their second pillar of success for their business. Now what Apple's product ecosystem does is it raises the switching costs for the current product users. Now this is a competitive advantage for the company because it is restricting the product users from switching over to using other companies' products. Now Apple's product ecosystem consists of every product and service that the company offers. This includes their iPhones, their MacBooks, their iMacs. They recently introduced their HomePod. They have the Apple Watch, they have the AirBuds, and they also have a bunch of services like Apple Music Plus, they have the iCloud, and they've been introducing new services like Apple TV Plus and Apple News. So all of these products and services increase the switching costs for users, because if they're going to be using another product from another company, they're going to have to switch over from all of these products and services over to another. And as many of you Apple users know, Apple products work the best when used with other Apple products. And this is all done by design to keep users within the product ecosystem, and is one of the pillars that the company has been using to build up such strong brand loyalty. Now this is something similar to what banks do. Banks also have very high switching costs, because if you want to move all of your banking over to another bank, it's very costly and time consuming. So a lot of consumers just end up staying with the bank that they originally signed on with. And this is the exact same thing that is happening with Apple's business, as consumers are in some way being trapped into that product ecosystem. And this is what is keeping consumers coming back. But luckily for Apple, they have a lot of really great products. So a lot of people aren't even upset to be trapped in the Apple product ecosystem. But you should be aware as an investor that this is a primary advantage for the company, and is what helps them remain competitive against other companies who are entering the market. Now, I myself am an Apple user, so I'm very familiar with the Apple ecosystem and what it feels like to be trapped within the Apple ecosystem. I have an iPhone and a MacBook. However, my MacBook's keyboard recently stopped working, but I have had the laptop for over 6 years, so it's totally fair for it to stop working. And I have been wanting to switch out of the Apple ecosystem for a while now, but I'm finding it very challenging because I would lose all of my playlists that I've built up over 4 or 5 years of using Apple Music. And I would also have to transfer all my photos out of iCloud, which would just be a massive pain for me, and I really just don't want to do it. So I have felt what it feels like to be stuck in the Apple ecosystem, and I'm not even that upset that I'm stuck in the Apple ecosystem because Apple has done very well by me so far. So I'm not upset to be in the Apple ecosystem, but I feel how strong of an advantage it is for Apple firsthand by being an Apple product user. So that is the second pillar that the company has built their business on. And now let's move into the third, which is excellent management. Now, if you're interested in learning about what it takes for a company to have excellent management, I talk about that in my most recent video, and I go a little bit more in depth about what it means to have good management and how you can analyze a company's management to assess whether that management team is good or not so good. However, for Apple, we're going to focus on three things in terms of their management style. The first is the company's return on invested capital. The second is going to be their investments in organic growth. And the third is going to be the redistributions of cash to shareholders. So starting with return on invested capital, or ROIC, this concept is essentially tracking the returns that a company makes on its assets. And you can very quickly calculate the return on invested capital by taking the company's EBIT and dividing it by the assets that the company has employed in order to generate those earnings. Now, the way that you use ROIC to assess a company's management is to compare it to the company's weighted average cost of capital. An average company in an average industry is going to have a return on invested capital equal to the weighted average cost of capital. Now, this means that the company is nor producing value or destroying value for you as shareholders because they are producing returns on their assets at the exact same rate that it costs them to fund their assets. Now, this is because the weighted average cost of capital is the rate that a company has to pay to fund the expansion of its asset base. So looking at Apple, their return on invested capital is 23% compared to a weighted average cost of capital of just 3%. Now, this is not something that you see in a usual company, and it shows you just how efficient the company is at transforming its asset base into earnings for the company and shareholders. So this is a very positive sign for you as a shareholder because a company that has a return on invested capital as high as Apple shows that they have a very strong and stable competitive advantage. And that's highlighted by the two pillars that we talked about previously, and that they have excellent products and they have a competitive advantage in their product ecosystem. So this is what allows the company to generate such great earnings on their asset base and is one of the signs of an excellent management team. Now, the second aspect we're going to look at is the company's investment in organic growth. Now, this includes anything like R&D, SG&A, capital expenditures, or investments in inventory growth, because these are all the things that are going to be organically growing the company's earnings. And what I mean by organic growth is that they are not buying other companies for their revenues. So these are just revenues that are being organically created by the company through investments in R&D or SG&A or capital expenditures. So over the last decade, Apple has spent $300 billion on investments in organic growth, and they have averaged around 15 to 20% of the company's revenues being spent on investments in organic growth. Now, this is very important for Apple's business because they operate in a highly competitive industry that is marked by very high innovation. So they have to be continually investing in creating new products and new services so that they can drive value for you as a customer and also for us as shareholders. Now, Apple, if you look at their business model over the last 2-3 decades, they create new products that have a life cycle of around 10 to 15 years. Now, you can take a look at their first Macintosh product that they came out with in 1984, which lasted around 10 to 15 years. After that, they came out with the iPod in 2001. That was the company's next great innovation. And then they came out with the iPhone, which has been the company's best product in its history, as it still represents the majority of the company's revenues today in 2020. And after the iPhone came the company's wearables, which did not produce as much revenue as the iPhone, because the iPhone has still remained the company's best innovation to date. However, you see that Apple has to continually invest in new technologies and new products in order to remain competitive in the market. So for that reason, it is great to see that they have spent $300 billion in the last decade on investments in organic growth. So now moving forward, we're going to take a look at the third factor, which is redistributions of cash to shareholders. Now, one of the things that Apple is probably most well known for is the massive pile of cash that the company is sitting on. They're currently sitting on around $100 billion in cash, and this is something that a lot of investors started to give Apple some grief for in the past decade because they wanted to see Apple start to redistribute that cash to shareholders through dividends or share repurchases. Now, that's exactly what Apple has been doing over the last decade. Ever since Steve Jobs died in 2011, the new management has started to redistribute cash to shareholders through both dividends and through share repurchases. And in the last 5 years, they have redistributed an average of 100% of free cash flows back to shareholders through share redistributions or dividends. Now, this is a great sign and it's something that you want to see as a shareholder, because if the company is so good at generating cash the way that Apple is, then you want them to be giving you that cash back if they're not going to be investing it in organic growth or other projects like acquisitions. You don't want them to just be sitting on cash for no reason. You want them to be giving you that cash back because it is likely that Apple is going to continue producing cash in the future, and you don't want them to just be sitting on that cash for no reason. So there is a great sign to see that management has started redistributing funds to shareholders, and the company's board has been continually approving share repurchase plans. So we're going to probably be seeing the same level of redistributions of cash to shareholders in the future, which is a great sign for you as a shareholder. So those are the 3 pillars that Apple has used in the past to build one of the greatest companies the world has ever seen. Now let's jump into the risk section of this video, where we're going to go over 3 risks that the company is currently facing that are important for you to know as a shareholder. The first is that Apple is starting to face increased levels of competition. And primarily, the main competitor that I am worried about in affecting Apple's ability to compete in the future is Google. And the reason why is because Google is getting into the same hardware space that Apple is with wearable technologies. They have the Google earbuds that are similar to Google AirPods. They have the Pixel phone, which is about half the price of an iPhone. And they also have one of the greatest product ecosystems of any company on the market today, arguably the best product ecosystem. Now, where Apple has been lacking is in developing products for the smart home. And that is where Google has excelled. They have bought the company Nest. They're also investing in gaming with their Google Stadia. They have hardware like Google Pixel phone, as we just said, and the Google Pixelbook laptop, which all are getting great reviews. And they also have over 1 billion users that use Gmail and YouTube. So I think that Google has one of the strongest potentials for taking away market share from Apple. And I think that that's going to be a serious risk for Apple in the future, as they do seem to be falling behind Google in terms of developing a stronger product ecosystem. They were behind Google in creating the at-home assistant, Google Home, which Apple replicated around 2 to 3 years after Google with the HomePod. So it kind of seems to me like Apple is starting to fall behind the competition. That's something we're going to have to keep looking out for in the future. And the one place that we should be looking is in augmented reality, as this is what Apple CEO Tim Cook has said is going to be the company's next big product. So if Apple falls behind in the augmented reality glasses, or they don't produce as good of a product as Google, then that's going to be a very big problem for Apple in the future. So that's the first risk that you should know as an Apple investor or a potential Apple investor. Now, the second risk that Apple is facing is that they lost the visionary Steve Jobs in 2011. Now, this was absolutely tragic, and Steve Jobs was the driving force behind what made Apple such a great company, because he was the one that was focused on creating this beautiful product ecosystem and having amazing products. So I don't know how good Tim Cook is going to be in replacing Steve Jobs, because I really don't think anybody can replace Steve Jobs. And Tim Cook is more of an operations guy rather than a visionary like Steve Jobs. So this kind of ties into Apple falling behind the competition in recent years. It might be because Steve Jobs is no longer leading the company and they don't have a visionary leading the company. So that's going to be a long-term risk for the company, and one that you should be watching out for by looking out for things like Apple falling behind the competition in their product development. Now, the third and final risk that Apple is facing is antitrust laws. Now, Apple has recently been subject to a couple of antitrust committee hearings, and mostly it's coming from unfair use of power in their App Store, which at the end of the day, I don't think it's that big of a deal in terms of Apple being able to solve that issue moving forward into the future. It's not as big of a problem as it is for Google, who has over 90% market share of the search market. So I think that Apple really is only guilty of making an excellent product that people love to buy. So I don't think that antitrust is that big of a deal for Apple as it is for some of the other major tech companies, although it still could result in some pretty large lawsuits for the company that might take away some of the cash flow of the company for a short period of time. But long term, I don't think it's that big of an issue for Apple. So with that, let's move into the final section of this video, where I provide you with the valuation of Apple and an investment recommendation. Now, if any of you want to use the models that I'm showing you in my videos, you can find all of them for free in the Google Drive link that I attach in the description down below, where I provide all of my valuations completely for free. So if you want to play around with the models or look at some of my valuations of other companies, you have access to all of those completely for free. You can also find them on my Facebook group, which I've also attached a link to in the description down below. So to find the valuation of Apple, I used a value of growth model. Now, a value of growth model is very similar to a discounted cash flow in that you find the company's free cash flows, you divide it by a discount factor, you add back cash, and you subtract debt in order to find the value of equity for the company. The only difference between a value of growth model and a discounted cash flow model is that I'm not predicting what the future growth in the company is going to be. I'm valuing the company's free cash flows as they are today, and I'm adding a factor for growth in the future so that future growth in the company is accounted for. Now, what you should be aware if you're using a discounted cash flow or a value of growth model or any other model that is dependent on a discount rate, the way that these models are, is that they are extremely sensitive to the discount rate being used. Now, the discount rate that I used in this model is the company's weighted average cost of capital, and that is very sensitive to the risk-free rate. So let's take a look at what happens when we play around with the risk-free rate, because right now the market conditions are such that equities can be priced extremely aggressively because the risk-free rate is near zero. But what would happen to Apple's valuation if the risk-free rate were to rise up to 2%, and let's say Biden wins the election and the tax rate jumps up to 28%? So given the current market conditions with the risk-free rate at 0.71% and the tax rate at 21%, Apple's intrinsic value comes out to $440 per share pre-split, or $110 per share after the stock splits on August 31st. So that means that even though the market conditions are such that equities can be priced very aggressively, Apple's stock is still considered overvalued. Now, if we were to raise the risk-free rate from 0.71 to 2%, and we raise the corporate tax rate from 21% to 28%, Apple's valuation falls from $440 per share to $297 per share. So if we were to buy Apple today and the risk-free rate were to rise and Biden were to win and the tax rate were to go up, then you would be buying into an extremely overvalued stock, which is why my investment recommendation for the stock right now would not to be buying the stock. I also wouldn't be selling it because it's an incredibly good company and I wouldn't want to bet against Apple, but I wouldn't be starting a new position in the company at its current valuation. In addition to that, because of this split and because of what I said earlier, that I believe that the hedge fund industry is going to be dumping their shares on the retail market, I do not think that this is a great time to be buying Apple's stock, even though the company is going to be going through a split. The stock is pretty overvalued. Even under the current market conditions, it is considered overvalued. And I think that the rotation of hedge funds exiting their positions in Apple and into more safe companies is going to have a pretty significant impact on the stock price. And I wouldn't start a new position until the company's valuation falls down to that which would be reasonable if Biden were to win and the risk-free rate were to go up to 2%. So that is my recommendation for Apple stock. You can take it or leave it. I am not a financial advisor. This is purely just my opinion on the company. But I do hope you guys enjoyed this video and learned something new. And I look forward to seeing you all in my next video. Have a great week.